Session 3.4, more on materiality, objectivity, and conservatism. This video you'll find in Module 4. We're coming back and circling back to financial reporting concepts and principles. Notice that time value of money will not be on the exam. We'll do it when we do our long-term liabilities instead. Time value of money later. We've talked about the structure of the conceptual framework, that we need to know about the why we're doing it and the how we get it done. And we're coming back and we're going to talk about some of the things that help us make good decisions. And those decisions are impacted with two exceptions when we measure, and that's materiality and conservatism. Materiality, or something that's immaterial, has little or no effect on user decisions, and conservatism says it's best to tell a sad story than overinflate or overpromise what has happened or will happen. So we're going to spend a little more time here. Materiality. When companies get in trouble, it has to do with them saying things are immaterial a lot of times when they are material, that they're not telling the full truth. So they want to ignore normal accounting conventions because they're like, oh, it doesn't matter, but it does matter many times. So when you take things and you pass it by the independent auditor before you do something, or you choose one method of accounting for a transaction versus another, what you're trying to do is tell the story to the full disclosure that you can, and not meet the materiality exception. So you're trying to tell it like it is, and there's always a push-pull in whether the auditor is going to say, yeah, that looks like a good way to handle that transaction, or the new adoption of an accounting standard, or whatever. But they're trying to give full disclosure and make sure anything that's material is available for users' informed judgments. So, what does that mean? That means that materiality should be based on all the facts, both qualitative and quantitative. It used to be that you'd say, well, materiality, it's 2% of something. If it would change your decision because it's more than 2%, then you should disclose it. Now, we want to think about qualitative as well. So we want to think about things and whether they're misstatements that arise from precision of measurement, and so that your estimates are the best that they can be, that you're not fudging your estimates to get your earnings to be what you want them to be, that you're not masking the changes in earnings and other trends. You can see that if earnings management, if your net income just gradually goes up a little bit every year, that's managing your earnings, because most people's earnings, especially this year, is going to look like this. So it's not smoothing of earnings. You don't want to hide your failure to meet analysts' expectations. In other words, your forecasts or what you've promised. If you're not going to make those promises, don't try to hide it. Changes in losses of income and vice versa, changes in profits. you want to tell it like it is, not to conceal or manage. You want to have concern that the segment or other portion of the business that has been identified as playing a significant role is those concerns are surfaced and addressed in the financial statements as well as the management letter. We want to think about regulatory requirements and how those regulatory requirements make certain compliance issues more prominent. We also want to talk about loan covenants. Loan covenants are a lender lets you borrow money, but you have to keep certain ratios, like you must have a current ratio of at least 2 as long as that loan is outstanding. If you break a loan covenant, meaning your current ratio becomes less than 2, then the full loan comes due. So you have to meet the terms and conditions of the loan, in other words, the loan covenants, in order for that loan to be enforced. And otherwise, its repayment becomes accelerated. You also have to think about how management's decisions impact management's compensation, and to make sure that it's full disclosure, fair, and anything that would be material is shared. So, one of the main things that we've talked about in the past is keeping expenses as assets rather than as expenses, because if they're assets and have and you can make the case for having future or potential value, like WorldCom and their maintenance expenses, that they said, oh no, that makes that equipment worth so much more in the future. It's just going to live forever. Instead of routine maintenance, by keeping it as an asset, they were able to boost their net income because their expenses were less than they really were, and their balance sheet looked better because those maintenance expenses were capitalized, meaning put on the balance sheet rather than on the income statement. So we need to think about the materiality, and would it change the decision of an investor if it was on a balance sheet or an income statement. So we know that conservatism means, when in doubt, understate assets, overstate liabilities, accelerate the losses, and delay the gains. Here's one. We have a analyst who warned investors in The Motley Fool that more than any other type of company, financial companies have immense discretion when it comes to the earnings they report. The key is estimating the rate of loan losses they will experience. In other words, it's like accounts receivable and the allowance for doubtful accounts. You know that you have loans or accounts receivable, and those customers are going to repay you, but you can estimate how many are not going to repay you. And depending upon how big your estimate, your expense for the year is, will impact what your net income is for the year. So every year they debit bad debt expense. And they credit this allowance for bad debts or loans. Bad debt expense is an expense. So if I underestimate it and make that expense too little, then my net income gets larger. My allowance for bad debts is a contra asset account. So depending upon what I do to that as far as the size of the estimate that year, I am also able to manage what my current assets are going to be. So that is their wide discretion about changing their estimate in terms of what their largest expense on their income statement will be. This is something to watch, especially this year because of the coronavirus and the pandemic, because there should be a lot of bad debt expenses this year. The estimates should be much, much higher than they would be in normal years, which means your net income is going to be smaller and your assets will be smaller as well. So when we think about this, smoothing of earnings means that depending upon what number the bank picks for its bad debt expense, the estimate, it can make its income statement, net income, look like that versus the reality simply by changing their estimate of loan losses or bad debts. So there's an exam that's going to come up for our midterm, and these are a couple of instructions just so you're aware. We'll go over this again. The exam format will be multiple choice and problems. Once you've downloaded the exam, you can have no further discussion of the topics covered on the exam with anyone. So if you're planning on studying for the midterm or preparing for it in your study group, do it before you download that exam. How will I know? Because part of the exam is you will be signing the Goizueta Honor Code Pledge. So basically you're telling me, and your integrity is telling me, that you followed the rules and that the exam is by your own hand and your own mind, not anyone else's hand or mind. Now, that's the honesty part of it. Also realize that the exam is open book, open note. It's just not open people. So return your exam, the answer sheet, and all your working papers to me via email attachment before the end of May. Thank you so much. Good luck on the exam.